Good afternoon and welcome to the 811th meeting of the Economic Club of New York. I'm Barbara Van Allen, President and CEO of the club. I hope everyone had a wonderful summer and that you're looking forward to a successful and enjoyable fall, hopefully in the room with us on many upcoming occasions. Recognized as the premier nonpartisan forum in the nation, the Economic Club of New York stands as the leading platform for discussions on social, economic, and political issues. We've been doing this for more than a century, and it's a pleasure for me to welcome today students joining us virtually from Fordham University, NYU Stern School of Business, and the Graduate Center, as well as members of the 2025 class of ECNY Fellows, a select group of diverse, rising, next-gen business thought leaders. We're going to be opening the application process for the 2026 class October 1st, so please stay tuned for that and start thinking about talented young people in your organization that you think would benefit from such a program. I'd like to also extend a warm welcome to our new club members who joined us over the summer and are joining us today for the first time. And there's actually quite a number in the room. So thank all of you for being here. It's my honor to welcome our guest and Chair Emeritus of the Economic Club of New York, someone I've worked with very closely all through COVID, is John Williams. John's the President and CEO of the Federal Reserve Bank of New York. In that capacity, he serves as the Vice Chair and a permanent member of the Federal Open Market Committee. From 2011 to 2018, John was the President and CEO of the Federal Reserve Bank of San Francisco. Prior to that, he was an EVP and Director of Research at the San Francisco Fed, which he joined in 2002. He began his career in 1994 as an economist at the Board of Governors at the Federal Reserve System. In addition, he served as a senior economist in the White House Council of Economic Advisors and as a lecturer at Stanford University's Graduate School of Business. He holds a PhD in economics from Stanford, an MS degree from the London School of Economics, and an AB from the University of California at Berkeley. His research focuses on monetary policy under uncertainty, very topical, business cycles, and innovation. He's a research associate at the Center for Applied Macroeconomic Analysis and served as managing editor of the International Journal of Central Banking from 2011 to 2016. John will open with some brief opening remarks, and this will be followed by a conversation in which we're delighted to have fellow member and chief investment strategist at iCapital, Sonali Basak, doing the honors. As a reminder, this conversation is on the record, and we do have quite a bit of media both in the room and online. Without further ado, please join me in welcoming John to the stage.
Well, thank you, Barbara, for that kind introduction. It also brings back memories of the many times I've started these events with those opening remarks. I'm delighted to be back at the Economic Club of New York. I've worn many hats here at the club. One as a longtime member, one as a repeat guest like today, and of course once as chair. And I'm pleased to see how the club's programming continues to evolve in the service of its very important mission. So before turning to the conversation with Sonali Basak and I'd like to take the next 10 minutes just to share the outlook, my outlook for the economy and how I see the path forward in the current environment. So for that, I'm going to put my Federal Reserve hat back on and give the standard Fed disclaimer that everything I say reflects my own views and not necessarily those of the Federal Open Market Committee or others in the Federal Reserve System. Now, there's a lot to say about where the economy stands against the backdrop of the Federal Reserve's dual mandate goals. So I'll start with what we've learned from the data in recent months and how it relates to maximum employment and price stability. The GDP data oscillated quite a bit in the first half of this year, largely reflecting the effects of the front running of announced tariff increases. Looking through the downs and the ups in the data, growth in the first half of the year was about 1.5%, well below last year's 2.5% pace. And this slowdown in growth reflects a variety of factors influencing the supply and demand sides of the US economy. Much lower immigration and the sizable increases in tariffs reduce both the productive capacity of the economy and demand. And in addition, the changing landscape around trade policy has increased economic uncertainty among households and businesses, further weighing on demand. And we've seen this in surveys and outreach that we've conducted within the Fed's second district, but also across the country. While the extent of tariff increases is becoming clearer, there's still substantial uncertainty surrounding the path of trade policy and the effects on the economy. Well, GDP and related measures are an important part of the overall picture, but my view is informed by a wide variety of other economic indicators as well. And those are consistent with a picture of an economy that is growing, albeit more slowly than last year. Looking at the totality of the data over the past year, there has been a gradual cooling in labor market conditions to levels that were similar to those that prevailed in the years prior to the pandemic. And you can see this pattern in the data of hiring and quits rates, in vacancies, and survey measures of job and worker availability. And this cooling of the labor market is consistent with the slowing of wage growth that we've seen. In addition, there's been a notable slowdown in payroll employment growth in recent months. But this is likely the result of lower growth in both demand and supply, reflecting in large part the effects of reduced immigration on the labor force. So I draw three conclusions from the labor market indicators. First, the labor market is currently in balance and not adding to inflationary pressures. Second, the gradual cooling of the labor market is consistent with the overall slowing in overall economic growth and my assessment that monetary policy being modestly restrictive. Third, as we are seeing today, when there are sharp changes in labor supply, it can be challenging to assess the rate of growth, job growth, consistent with that labor supply, and I therefore put greater weight on other indicators of the level of labor market conditions in assessing the strength of the labor market. So now I'll pivot to price stability. Over the past year, the core services components of inflation have evolved broadly in line with gradual progress towards our longer run 2% goal. Based on the 12-month percent change in the personal consumption expenditures price index, headline inflation was 2.6% in July, and core inflation was 2.9%. And these figures are modestly higher than comparable numbers from a year ago. The big story here, of course, is tariffs. There are clear signs that tariff increases are affecting consumer prices and that trade diversion is taking place. One area where we can clearly see the initial effects of tariff increases is in core goods prices. Price increases for items that are exposed to higher tariffs have been well above what one would have expected based on past trends and in the absence of tariffs. The realized aggregate effects of tariffs so far have not been as large as expected earlier in the year, but it's still early days and it will take time for them to come to be fully realized. Combining enacted and announced tariffs, estimates of the average effective tariff rate range from between 15 and 20%. By comparison, net tariff receipts as a share of imports rose from about 2.25% in the first 3 months of the year to about 10% in July. And this is a sizable increase for sure, but well short of the increase implied by a straight read of the announced tariffs. Fortunately, I am not seeing signs of amplification or second round effects of tariffs on broader inflation trends. In particular, recent readings of the New York Fed's Global Supply Chain Pressure Index are near historical averages. And longer run inflation expectations have remained stable, and while short and medium term inflation expectations, after increasing modestly early in the year, have returned to their pre-pandemic ranges. And this is critically important because well-anchored inflation expectations are essential for sustained price stability. So all in all, I expect tariffs will boost overall prices by a total of about between 1 and 1.5%, with these effects continuing through the first half of next year. Now, that's my current estimate, but there's a great deal of uncertainty about these effects. And as we collect more data, we'll get a better understanding of the magnitude and timing of tariff effects. And I'll continue to monitor prices and broad movements in inflation over time to assess evolving conditions. The Federal Reserve's monetary policy stance has been modestly restrictive, as seen through the slowing of inflation and wage growth and the gradual cooling of the labor market. This policy stance is appropriate given that inflation has remained above our 2% target, while the labor market has been generally consistent with maximum employment. And with that backdrop, the FOMC decided to leave the target range for the federal funds rate unchanged at 4.25% to 4.5% at its meeting in late July. Looking ahead, if progress on our dual mandate goals continues as in my baseline forecast, I anticipate it will become appropriate to move interest rates towards a more neutral stance over time. This expectation reflects a delicate balancing of risks to our mandate goals. On the one hand, we need to keep the labor market in balance to ensure that the effects of tariffs do not spill over into a longer-lasting broad increase in inflation. On the other hand, maintaining a stance of too restrictive policy for too long could increase risks to our maximum employment mandate. My approach to these assessments is, as always, entirely focused on the totality of the data and what it tells us about the relative risks to achieving our maximum employment and price stability goals. Let me briefly comment on the Fed's balance sheet. The FOMC continues to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities, and that process is going very smoothly. With take-up of the overnight reverse repo facility now quite low, the level of reserves has already started to decline and is expected to decline more meaningfully going forward as our asset holdings continue to shrink and other liabilities rise. We continue to closely monitor a range of indicators related to the ampleness of reserves. So I'll conclude with my economic outlook, and let me say at the outset that a number of outcomes are possible given all the uncertainty. But based on what the data tell us today, I expect the combined effects of trade and immigration policies and associated uncertainty to continue to weigh on growth. As a result, I expect GDP growth this year to be between 1.25% and 1.5%. And with this slowdown in growth, I expect the unemployment rate to gradually rise to about 4.5% next year. And I expect PC inflation to come in between 3% and 3.25% this year, before declining to around 2.5% next year, and then reaching 2% in 2027. A lot has happened since I last stood at this podium, but you won't be surprised to hear that my penchant for data dependency has not altered. The outlook remains uncertain, the data can shift in unexpected ways, and in navigating these uncertain waters, I remain laser focused on supporting maximum employment and returning inflation to our 2% longer run goal on a sustained basis. Once again, I'm honored to be back here at the Economic Club of New York, and I'm looking forward to our discussion. Thank you.
Thank you, President Williams, for taking our questions today. Of course, it's a very critical juncture in the markets and in the economy. And I want to start with first what's right ahead of us. We'll talk about the short term and the long term, but what's right ahead of us is another critical non-farm payrolls print just tomorrow, at a time where a lot of investors and Americans are starting to get increasingly concerned about the job market. Now, how do you think about that one reading relative to what you had just said, that you expect the unemployment rate to slowly tick up to 4.5% into next year?
So first of all, I said that I'm very data dependent, and I've been saying this for over a decade, but I'm not data point dependent. And I think it's really important to look at the broader contours of all the totality of the data. If you notice in my speech, if you looked, I mentioned a whole bunch of indicators I'll look at, and we just got the JOLTS data just recently, and so I look at a lot of that data along with the other indicators, including those on growth, on the labor market. So I'm not looking at just one data point. I am, thinking that the employment report clearly is a very important part of the data. It tells us where we are on employment, which is a very important measure for maximum employment. So, really what we've been seeing, I think more importantly, is this I mean, I see clear signs of gradual cooling of the labor market. All the indicators are kind of saying job growth is slowing. Indicators of level labor market are softening a bit, but still in a reasonably good place. So I think it's really looking at the labor report and the data we also get between now and future meetings. Is it telling us something different about that overall trend? So that's what I'll be looking at, and not so much like exactly what the headline is there, but what's it telling us about our trends? Is this trend continuing of a slowing in the labor market? Is it telling us something different? Obviously, looking at the compensation data, the wage data, and the unemployment data as well. So looking at the totality of data and how it fits in the big picture.
As the labor market comes into further moderation, what are the parts of the economy you're becoming more and more concerned about?
Well, I think that, really there, I'm going to say the thing that I think every macroeconomist has said a million times, the consumer. The consumer's consumption is 70% of the U.S. economy. It drives the economy throughout every business cycle. So watching that, we're watching all the indicators of income, credit conditions of the consumers, the credit card data, and all of that. And also, this issue that we saw early in the year, I talked a lot about this, everyone did, the soft data versus the hard data. In the soft data, the surveys, the Michigan survey and other surveys, consumers have seemed a little bit shaken and a little bit unsure about where things were going in the economy and maybe hunkering down a bit. We hadn't seen that in the hard data so much, so really trying to watch that. The other area that obviously I'm paying a lot of attention is business investment. The investments in AI and in tech more generally have been extremely strong, and that's an area that might be providing additional support to the economy. So it's looking at all those pieces, but definitely the consumer always gets a lot of attention given the importance of the economy.
And hold that thought on AI. We will definitely get back to that further in the conversation. But as far as the labor market goes, a lot of people are looking at the unemployment rate and wondering what labor force participation is doing to that unemployment rate. How do you think about the supply challenges in the labor market today?
Right. So, we talk about this in an aggregate level. The unemployment rate is 4.2%, but of course we have an economy with hundreds of millions of people, lots of, literally thousands of economies within that. And so one of the things we definitely have seen is some a tick down in the labor force participation. I think that is reflecting some slowing in the labor market. And I think the other indicators are kind of telling us the same thing. I think the hardest challenge, and we've seen this over the last several years, is that we have these big swings in underlying labor force growth, primarily through immigration, either fast immigration growth or the significant slowing of immigration growth. So that's kind of the supply side of the economy is shifting quite a bit. We don't have great real-time data on that, but we definitely see it in terms of the employment numbers and some of these other numbers you were talking about. So that's why it's hard for me to say, is a payroll number of X or Y or Z, is that good, or is that the break even? But then you look at the unemployment rate, you look at the vacancies, the quits rates, and some of these other indicators, or the initial claims for unemployment insurance, to give you a kind of an independent read on what's going on.
A lot of people are talking about job openings, a propensity to hire, and even layoffs. When you talk to businesses, what are business leaders telling you about their propensity to either lay off or hire at this point?
So what's really striking about this economy right now is this is a very low turnover economy. It's a low churn labor market. So hiring rates are low, quits rates are low. Normally you might think, well, when the economy strengthens, you get, a lot of vacancies, you see people quitting jobs, because they're going to other jobs and things like that. But right now, I think employers, and this is what I'm hearing from employers, but this is what you're seeing in the data, are saying like, hey, I got burned on this thing about laying off workers in the pandemic cycle. I want to keep my employees in place until I find out how the economy is going to kind of respond, through this year and next year. I want to get a better fix on where things are before I make some strategic decisions. So we've seen kind of layoff rates stay very low. And we've also seen employees saying, hey, I'm a bit uncertain about where things are. This isn't the red hot labor market of 2021, 2022. And we're seeing kind of quits rates come down. So this is kind of one of those things where everything's kind of a little bit watch and inflation weight in the labor market. In a position like 4.2% unemployment rate, that's a pretty good unemployment rate. It's relatively low, but it's one where I think that there's just not as nearly as much activity in terms of people switching jobs that we normally would see.
If you had to boil it down at this juncture, are you more concerned about the labor market or inflation?
Well, this is the core question of monetary policy. We have two goals. 2 years ago, if you asked me what was a concern, inflation was very high, unemployment was relatively low. It was clear what to do. Here we're seeing the risks, if you will, because I always think about monetary policy, as Barbara mentioned. I study monetary policy under uncertainty. I think that was a good choice rather than monetary policy under certainty, since I've never experienced that. But in the world of risks management, it's clearly the case that some of the downside risks to the employment side of our mandate have increased. I think, as I pointed out in my comments, although the tariffs are definitely increasing short-term inflation in the near term, I'm not seeing signs of that maybe spilling over to broader inflationary trends yet. So I think that the balancing here has moved some of the concerns around the employment mandate a little higher, and on the margin on the inflation mandate a little bit lower. And from a policymaker's point of view, it's really trying to get those risks, choose monetary policy to get those risks in as good a balance as we can, given it's a relatively fast-changing economy.
And before I ask you about more risks to the inflation side of the equation, what is the biggest risk to the labor market over the next 12 months in your view? What would push it beyond that 4.5%?
Well, I think, you're asking me the hardest question, the economists are not great at it. That's predicting like an economic, turning point. And that's hard to predict. I think one of the issues is you always think about is are the consumers kind of just going to hunker down more? They've kind of used up the credit that they have available, or just be more cautious. So that's one of kind of a dynamic you worry about. I think the other thing is, a dynamic can take place if things cool, that people just get more cautious and cut back on spending on things like that. And of course, there's always the external kind of development that affects things. But I think really my concern is that somehow a dynamic sets in, the labor market cools further than I think it would be desirable from my point of view.
How are you thinking about different cohorts of the American economy being impacted differently? Because for years now, investors have been finding evidence of a K-shaped economy forming. There are a lot of concerns that tariff pressures could disproportionately impact lower income communities, and potentially same for the job market. How do you see that playing out, and do you have concerns about exacerbating economic inequality?
Well, I'm laser focused on maximum employment price stability, but we're definitely following all the different dimensions of this economy and how it's affecting different sectors, different populations, and understanding, again, that full picture of this. The one area we definitely see the labor market kind of evolving differently right now is in this area of the new college graduates, where employers are, I think, being on the margin cautious about hiring people into jobs that maybe AI would be replacing. So we're not seeing layoffs. We just did a blog post on this from the New York Fed, which I highly recommend. But employers are not talking about laying off employees because of AI right now. They're talking more about being very intentional as you think about who are you hiring, what skill sets you have, and also focusing, as we are in all of our organizations, I'm sure, of how do we take our existing incredibly talented, dedicated people and make sure they have the skill sets that will make them successful there. So I think that's just one area we're seeing this labor market look a little bit different, because historically, a group that's a very low unemployment rate would be recent college graduates, and this year it seems to be different on that.
This is definitely a talking point that keeps on coming up, and wondering how long this goes on for and what can be done about it ultimately.
Well, and I think we hear a lot about it because a lot of us have kids of that age, so who are confronting this issue. So, and it's in the data too, so there's no question about it. I think one of the things that I always go back to is when you think about someone who comes out of college or comes out of other school, is that you really want a general purpose technology. I'm being very nerdy here, but you want ability to actually adapt to different kind of role, different jobs or different kind of skill sets you have. So to me, you should never think about, I have this skill set. It's instead, I have this foundation that allows me to tap into and learn different skills. I mean, all of us through our careers are doing things today that we didn't do when we were in high school or college or earlier in our career. We're all using technologies in different roles and having to excel at new things. So I think for this group, I think maybe we're just relearning is a lot of those skills, the soft skills, if you will, the communication skills, the adaptability, the kind of, I need strong analytical skills. What I have now are tools that are going to really increase my productivity of that. So when I think about a lot of the new hires that we've hired, it's really getting them out of the kind of what one of my employees said was soul-crushing work of data collection and actually using all that education and skills to do the data analytics adds value.
Yeah, it's very hard not to jump right into the AI conversation. But let's take another step back. We started to talk about inflation, and a lot of people are looking at the inflation data and worried, frankly, about where services inflation is headed. How do you see this playing out? Do you think that it'll start moderating soon, or do you think that there's still upward pressure?
Well, I think I view the overall trend in services inflation as actually being favorable. We have to take a longer picture. Again, I don't want to be data point dependent 1 month here or there. Things move around. I mean, a couple years ago, many of us, and I know I were saying that housing inflation in the data would be coming down. We were looking at all the forward-looking indicators and telling us, of course, the data doesn't like to agree with public pronouncements on it. And so it took a while, but we've seen the housing inflation data now come down pretty significantly over the past year. On the non-housing part of services, that has also come down. It hasn't moved a lot recently, but I look at the wage data, the compensation data, other indicators. It tells me that this part of our economy is also kind of normalizing and moving towards the 2%. The one area where I think the inflation data is kind of shifted is in the core goods. And again, I think to the best of our knowledge, a good chunk of that is really related to tariffs, not kind of macro imbalances.
If the president does not succeed in executing on the IEEPA tariffs, what happens? How does that change the picture for you in terms of where the economy is headed?
Yeah. So there's we all live in a world where there's a lot of uncertainty about, different policies, trade policies, and I guess you're referring here to, the courts and all this. And so from my perspective, you have to have a base case. My base case is the tariffs stay in place. Kind of the announced tariffs happen and do the analysis based on that. But like anybody, we do a lot of scenario analysis. What would happen if tariffs went up, who came down, and for a variety of reasons. And really want to think through understanding what would the impact be on our economy, and most importantly, what would the impact be on our employment and inflation goals. So there's a lot of uncertainty about how things could transpire. My base case assumption for my outlook that I talked about is that the tariffs basically that have been announced and put in place will continue.
So what does this mean for any ripple effects? Even the Section 232 tariffs, if you think about it, it's a lot of critical inputs to goods that you would even look to manufacture in America. Things like lumber could impact critical areas like housing. Do you see that having secondary effects? Do you think that there could be real ripple effects headed into 2026 and beyond?
Right. So absolutely, we have some really great economists who study this, and so for this crowd, I'll go all econ nerdy here, but we do a full input-output analysis of how the U.S. economy works. So for example, if you're making appliances or cars here, you're using steel, and steel could be affected by tariffs. Similarly, if you're building houses or other things, lumber goes in that. So we try to capture all of those connections in our economy, both for domestically produced and also for imported goods, into this. So if you recall in my remarks, I said I expect these tariff effects on overall inflation to play out through the middle of next year. Now that's not because I'm expecting new tariffs in the middle of next year. It's because of these basically it's a transmission of the tariffs through all the goods and services in our economy. And that includes services too, by the way, because services often have imported goods as part of the cost of that. So that's what's built into my baseline. I think it's important though, that's kind of almost a mechanical or economic kind of modeling, mechanical way of thinking about that. I'm not, in my view, I'm not expecting there to be some kind of, beyond that, some kind of longer term inflation, persistent inflation effects of the tariffs. And the reason I say that is because in my view, we're going to get, we'll do our very best to get monetary policy right to make sure we're not allowing imbalances to appear in the economy. So we have to do our part to keep the economy on a good track, like as I mentioned, and then let the tariffs kind of effects just pass through. So there's two parts of this that I think are important. One is kind of the direct and indirect effects you're talking about. The second is to make sure inflation expectations stay anchored, make sure that we don't get persistence beyond, say, the middle of next year.
And, I think a lot of people would appreciate, you began talking a lot about your looking at data and data dependency, but the hardest question of today is definitely around Fed independence and what is happening with different members of the Federal Reserve. As we sit here today, you do have Stephen Myron in a hearing regarding a critical Federal Reserve post. Of course, then you have the issues around Lisa Cook and the administration as well, and the dispute that's playing out and will be playing out in courts. How do you talk to people about Fed independence today? Do you find that you have to defend it? Do you find that it's becoming a bigger question? And when would that spill over into actual issues of Fed independence?
So, it's a great question. I think Fed independence is something that, or central bank independence, I should say, for any country is critically important. And it's been instituted in countries, throughout the world. In my job, I meet with my counterparts from countries, central banks from around the world, and the vast majority of them have independence to take the monetary policy actions that they think is best. And the reasoning for this in countries around the world is that short-term political pressure can exist to say, let's get the economy stronger today, and not fully reflect the long and variable lags that Milton Friedman famously talked about with monetary policy, which can bring inflation later or bring uncertainty and negative consequences. So I think, you look around the world, central banks, governments, countries and central banks have had independence for now often for decades or even longer, and it's to serve their countries and the public, in our case, the American public. So it's not something we like or I like because it feels good or it's comfortable, but it's really because I think the evidence and experience around the world shows that having these decisions on monetary policy, which have effects that can last years or even decades, to take place away from the short-term political pressures, even though it's part of the broader, obviously, the policymakers are chosen by typically governments, and we have accountability, in our case, to Congress. You look at countries that have not had independent central banks and governments in the worst cases, like we had just a few years ago with Turkey or others, that led to very high inflation, very, very disruptive economic and harmful economic outcomes in some of those examples and through history. So I think independence has been proven to be a very effective way to kind of safeguard monetary policy from very short run or partisan concerns. Is something that let me just say how I experience it. I've been in the Fed, as Barbara mentioned, for 31 years, since I was 12, and it's an institution, the Federal Reserve, that I obviously think is amazing. It's full of dedicated, committed people who are not political, not partisan, who are focused on all the data we're talking about, analyzing all of that. And whether you come from one administration or another, you're chosen like the presidents are in a different process, we all come together and we're just focused on what we do and the importance of getting it as right as we can. We're not, we're just human beings. You make decisions with the information you have. You adjust as the data comes through. But it is a remarkable institution in the sense that we're the people who want to be in the Fed and the people who join the Fed really take on that role of saying, hey, this is important to get right. It's important to carry this out in an independent way. And that's been, I think, one of our great strengths.
When you look at the bond market, of course, there are a lot of factors that are influencing the longer end of the yield curve. But do you think worries about Fed independence are one of the factors that are factoring in to the bond market volatility we're seeing today?
Well, I think the bond market is relatively calm right now. It reacts to economic news, it reacts to other news around trade policy and things like that. That's what you would expect to do. I think, for the markets to try to guess kind of what the implications of a lot of different things, speculate on hypotheticals of the futures is not necessarily something that they're focused on. I think they're focused a lot more on some of the fundamentals around what's going on in the economy, what's going on in fiscal policy around the world, and things like that. So I think that, from my point of view, a lot of what the markets are telling us is more about kind of what's fundamentally going on in the economy rather than trying to figure out, what does this mean for, other things.
So the reason I ask this as well is because there are a lot of investors who are betting on, of course, that September rate cut, but the short term versus the longer end of the yield curve. How do you see those two things interacting? And does the prolonged elevation, let's say, in longer term yields conflict with the efforts to cut rates and therefore have that transmit through the economy, given mortgages and other types of critical types of lending are more tied to those longer term interest rates?
Right. Well, monetary policy works at the short end of the curve. Always it has. And the long end of the curve is determined by market forces and investors' kind of views on things. So my view is that there are factors that affect longer end of the curve. It could be uncertainty. It could be other factors that affect that, the risk premium, the term premium, if you will. And those are things we take into account in understanding the financial conditions, understanding kind of what's happening in markets around the economy. Our job is really focused on the short end of the curve and to get the right policy that guides the economy in a way to achieve our maximum employment and price stability goals. I mean, I think that there's nothing here that's acting that abnormally. It's always the case that the long end of the curve responds to both expected short-term interest rates along with factors that affect the term premium, risk assessments and things like that. So we've always operated in that world, and I think my view is a monetary policy is a very effective tool to achieve our goals. It has been proven to be that, and so we just have to get the short end of the curve, the Fed funds rate decisions right, and also communicate effectively where we see policy going. September, we have our economic projections, we have the discussions of what we're trying to achieve and how we're going about that, which I think also helps the public to understand how we're thinking about things and how we expect things to play out, even though there's always a lot of uncertainty.
As far as how things play out, how do you think about the direction of travel for interest rate cuts moving forward? You mentioned the path to neutral, but what is neutral? Recently, you wrote a paper addressing the issue of R-star and any pressures around it. How soon do those pressures really play out? And is there a real risk here that neutral is a little higher than many people think?
Well, it depends what you mean by a little higher. I mean, if you mean a little higher, then that's hard to know, and there's some factors that might be making it a little higher. I think the question for me is, in the short run, over the next year or two, it's not really a question about what's the long run neutral rate. It's a question about how do you balance kind of the risks to maximum employment price stability. How do you deal with all the short run factors that are affecting the economy that aren't maybe related to longer term developments? But having a notion of where the economy is going in the longer run over the next 5 years or something, to me is intellectually, but also kind of how I put together my forecast and think about that is very helpful to ground that view. So my view is, the neutral rate. So the FOMC, I think the median had a neutral Fed funds rate, a real rate of about 1% or 3% nominal, something like that. I think, my own model estimates are just a little bit lower than that, but in that ballpark. So right now, we're above that. So when you ask me the question, where do I think we'll eventually go? It'll be interest rates that are lower than we are today, but with inflation at 2% and the economy at full employment. But that doesn't drive the decisions about what do we do at this meeting, the next meeting, and then the one after that. That's really a weighing of the various factors that are kind of influencing the economy in the near term and also the uncertainties and risks. As I said in a recent speech a few months ago, I guess now, in the practical policy making, it's always risk management. It's always about trying to make decisions where there's a lot of uncertainty and trying to get those risks as balanced as possible. All the kind of analysis of the neutral rate, our forecasts and things, I think are helpful for framing that thinking. But in the short run, you're dealing with the real world and sense of having to kind of weigh the uncertainties.
Speaking of the real world, and this is very near term as well, in addition to an FOMC meeting this month, there are a lot of people who are also watching things that are outside of the Fed's control. For example, any risk around a government shutdown, any risk around the Treasury general account, reserves in the system. The New York Fed is so close to the markets. How much are market participants talking about this, and are there real risks to the bond market given some of the market dynamics that are coming up and some of the fiscal constraints that there are?
Well, obviously, this is an area you're absolutely right. We focus a lot on these kind of market, kind of monitoring these markets, understanding what's happening, not just in the big picture like equity markets, bond markets, foreign exchange markets, but very much in the weeds of the markets we operate in, which are money markets and funding markets and things like that. And so we're follow that very closely. I mean, some of the things you brought up is clearly we've just come out of a debt ceiling episode. The U.S. government has been rebuilding its cash account at the Fed, the Treasury General Account, the TGA, there. And we're also seeing, as I mentioned in my speech, we basically have been shrinking our balance sheet for a couple of years now. We brought it down quite a bit, but now we're starting finally to see that kind of starting to bring the amount of reserves down. We're still at $3.2 trillion of reserves held at the Fed by the bank. So there's still a very high level. And all the indicators that we look at, and we look at a lot of them, and our discussions with market participants say, hey, the level of reserves is still very abundant. There's not an issue there of liquidity or anything. But as we go through the rest of the year, the level of reserves is going to continue to come down. There's going to continue to be adjustments on different dimensions, and we're just very focused on making sure that we obviously have a very good handle on that in analyzing it. But we also have introduced in recent years tools that I think help us, and one of them is a standing repo facility, which basically is basically a kind of a ceiling on interest rates. So if there were some kind of rapid movements in supply demand in those markets, that means that that facility is there to kind of cap any upward movements in interest rates, and we have the ONRP on the other side of that. So I think we think about this. We're not only monitoring this, we're making the decisions that are trying to manage this to make sure that money markets are working smoothly and everything, and the Treasury market's working smoothly. We also have the tools that are in place, ready to be used and have been used to make sure that is kind of supported in the market.
So what does this mean for the New York Fed to see market structure also changing to a fair degree? Over the last couple of years, there have been so many questions about the proliferation of non-banks, about the role of hedge funds in the Treasury market, about the basis trade being one of those factors. How do you think about the risks posed outside of the traditional way banking system, or at least what it means for the regular way functioning of Treasury markets?
I mean, a basic fact of the U.S. financial system is that it's a hybrid system of a capital markets, extremely deep, extremely well functioning and efficient capital markets alongside the banking sector. So this separates us from a lot of other countries which are much more banking finance. And those two actually are mutually supportive, and I think give us the resilience, the different ability to provide credit into our economy in a very good way. Of course, that also means that there's certain areas that are highly regulated, like the banks, and other areas are regulated in different ways. And so you mentioned hedge funds and the basis trade. So one of the things that we obviously study very carefully is understanding how that market dynamic may be changing, the players changing, the strategies of the players change, and understanding how those markets work, and obviously always looking for where's the leverage. I mean, where's the things that are hidden that could cause an issue if there was a market disruption. What's striking about 2025, given all the uncertainty in the markets, given all the things that have happened going back to early in the year and trade policy and other things, is that the Treasury markets and the funding markets around it have actually performed very well. We've seen times of stress, we've seen times of liquidity getting pretty low given the volatility, but markets have functioned throughout that. It's something we definitely focus a lot of attention on that. And again, I would point to the point I made earlier, is that we've we have these facilities in place to make sure that interest rates stay in the range that the FOMC has dictated. And I think that's actually very supportive to market functioning, because one of the risks here in, when you think about some of the trading strategies around treasury markets is that, big movements in interest rates can disrupt some of that or create disruption or dislocation. And so, we're doing our job keeping interest rates where the FOMC directed them, and those have been well behaved, and the market's been actually behaving very well. Now, that said, we're always studying this. We're always very focused on the treasury market. Let's be clear, the US treasury market is the heart of the global financial system. We saw this in 2020. If it's disrupted, then all the markets become disrupted around it and around the world. So this is critically important that we have a strong, resilient treasury market and make sure that continues.
When people said non-bank in the past, it often meant hedge funds or private equity or private credit rather. But these days, it could also mean stablecoins.
Yeah.
How much is the New York Fed talking about the role that stablecoins will play, particularly as they absorb more and more treasuries?
Well, this is clearly a very important issue. Congress, has passed the Genius Act. So we do have a federal regulatory framework, which is very important. Not having a federal regulatory framework is a problem. We also have the states have regulated, including New York State, on stablecoins. So I think, to me, that's a step. That's an important step. But the really important next step is to see how this regulatory regime is, constructed. They have time to set that up, and there's some very important regulatory issues to make sure that the stable coins that come out of this are actually meeting, I think, the intention of the law to be truly stable, truly backed by liquid assets, and done in a good way. I think that depending on how that plays out, this is an area that we are studying a lot. Thinking through different scenarios and which market segments are adjacent may be affected. Government money market mutual funds have some similarities, especially if you think about tokenized government money market mutual funds. Bank deposits have some similarities. So trying to understand for us how this market may evolve, not coming to conclusions about it, by the way, because it will depend on some of these issues. Looking at how international payments may be affected, because 98% of stablecoins currently are U.S. dollar stablecoins. I mean, we are the market for stablecoins in the U.S. And I think third is, how does it affect eventually how we carry out monetary policy? Now, I don't believe it in any way interferes with our ability to control monetary policy. That's not the issue. The issue is, you think about how we operate in money markets today. ONRP, your counterparties are money market funds. We obviously trade, operate in the repo markets. We operate with banks. So you have the financial system in the U.S. over the last 50 or so years has evolved in significant ways. How we can carry out or implement monetary policy has had to evolve with that. So when you think about stablecoins, I'm not making any announcements here or anything. I'm just saying that as this evolves, we are very, very carefully studying this, and how does it change kind of how money markets work and funding markets work, and how what does that mean for us? Some of that's just pure technology. How does the technology work? But also, eventually down the road, just understanding how markets work. Because what matters in implementing monetary policy at the end of the day, I mean, I'm clear on that. The FOMC gives the direction. It's kind of like Captain Kirk and Scotty. You're supposed, this is your order, and make it so. And I'm mixing up Star Trek references here, but we got to make sure that we're able to carry out monetary policy effectively. So that's why we study this carefully.
Well, at the same time, there's a lot of questions around what it would mean for the banks to face lighter regulation, particularly in relief for the supplementary leverage ratio. And in my conversations with the banks, there are a lot of questions about what this will mean in terms of how much the banks will actually start to absorb more treasuries, start to hold more treasuries. What do you think? How do you think that regulatory relief more broadly, particularly SLR relief, will play out in the system?
So what I think is, I agree 100% with what you just said. There are a lot of questions. Now, I think we're finishing up the comment period on that, so it'd be great to hear, understand better from the industry beyond the conversations we've been having for years on the SLR and the SLR and all that. But to really get a much better understanding of kind of where this would matter or not matter. It's not an easy thing to analyze, because a lot of this is about It's about regulatory constraints that are not binding, but are in the background, and people are making decisions, and also management decisions that are around, liquidity and things like that. So it's not just like I can get out a table and calculate something. It's really more about, how would maybe some businesses shift or not shift their business models around that. So again, I think we're going to be learning a lot from the outreach around that and decisions being made. This is something, again, we've been, following very closely, because liquidity in the Treasury market, in the repo markets, elasticity is a phrase we use a lot. The ability of the markets to expand and contract as conditions change. These are very important, and I think these are things that may potentially be affected in ways around some of these kind of regulatory changes. But again, I think it's an open question we're going to learn a lot about.
It's striking really how much the financial system has been changing over the last couple of years. I'm wondering how it's really impacted the way you think about systemic risk at the end of the day, given that there are so many new players in the market.
Well, when I think about systemic risk, I do think about this comment I made earlier about where's the hidden leverage. Where's the kind of the vulnerability or the risk that's out there, not just in kind of plain view, but that's behind the scenes. And so that's why you're always wanting to get a better view of the non-bank financial institutions, the NBFI world, where we don't necessarily have the amazing data we have on regulated institutions, where you can see the whole picture and understand that. So I think, to me, it's not so much that private credit is risky or not risky. It's not about that. It's more about, like, where are the issues that could go wrong? And where do you think about things like that? You think about leverage that people don't fully understand, or risk that's not fully understood. The other is the risk of bank runs, kind of classic bank runs, which we've had for centuries, but we also saw those kind of dynamics during the global financial crisis. So when I think about some of these things, like stable coins, I'm not being negative about it at all, but just have to think about, hey, how do you construct that product and issuance of stable coins in ways that basically minimizes risk, those kind of risks. So it's not about is it you for or against it. It's more about how is it managed in a way to make sure we don't create those kind of excessive risks.
Before I let you go, we talked a little bit about AI, and we talked about it in terms of the labor market, jobs that it might be competing with when it comes to people who are just leaving school, leaving college. But what about on the productivity side? A little bit earlier this year, I had a conversation with Treasury Secretary Scott Bessent, and he claimed that you would start to see it in the data, that you would start to see those productivity impacts. And my question to you is when and how? At what point do we really see AI being a bigger driver of the economy? And at what point does that really offset any potential pains that it does cause to the labor market?
Well, okay, that is a big question. This is a 2-hour thing, right? Is that what we're doing? So one thing is you will see it in the data eventually at some point. I mean, that's for sure. I mean, I've studied productivity innovation throughout my career. That's what I did my dissertation on, actually. And so when you have these what are called general purpose technologies, which AI is definitely meets the GPT test, the general purpose technology test, you see it eventually in the data. But what do we know from history? One is it can have profound, important effects on productivity. Often, though, it takes years or more likely decades to be fully experienced. The classic example in the 1980s was Bob Solow, future Nobel laureate, or maybe a Nobel laureate at the time, said that we see computers everywhere but in the productivity statistics. Well, 10 years later, you saw computers in the productivity statistics, and you've seen it ever since. So I think there is a time scale, and I know people are going to say, but this is faster and it's accelerating exponentially, but there is a time scale of adoption, learning, and finding new products and new uses. So I think that's one of the things. The other big question that I have, and I sometimes get painted as a skeptic here, but I don't mean it that way, is that AI could be extremely productivity enhancing for a decade or two. It could do all the things that people will hope it will do and make us more productive in our economies and our society. But it may just, in the end, be the thing that got us the productivity growth of the 2025 to 2035, 45 period. If you look back at history of the last 120, 130 years, the US economy stands out for the fact that it has generated decade after decade after decade of very good productivity growth of between 1.25% to 1.5%, depending on how you measure it. We've done that for over a century. This is the kind of the most amazing fact of the U.S. economy. It's a very innovative, productive, disruptive economy, and it has been, including in the 19th century, including the early 20th century, the post-war period, all the way to today. So the question I always have is AI the thing that, our grandkids are going to say, oh, that's right, that AI was like, integrated circuits, or it was like, automobiles or something like that. Because throughout our history, we've had amazing innovation and productivity. So the question is it going to be the thing that keeps us on that trend? Or is it something more like a boom that maybe is even better for the decade? I know I'm out of time. I can tell. I can see Barbara. I know Barbara too well. There is a big question about, does it hollow out some jobs? And that isn't going to be about productivity. It's about the distribution of income, and that's, I think, a big question that we're going to have to also be watching carefully.
Certainly a lot to think about.
Oh, there you are.
Back to Barbara.
John, Sonali, thank you. Really an honor to have you both here today. A great conversation. I'm pleased to announce we have a great lineup, speaking of that, for the fall. If you turn over your programs at your seat, and for those of you on Zoom, you can refer to the screen to see what is ahead. September 16, we have a luncheon with Lena Nair, the global CEO of Chanel. September 18, we will host the governor. September 29th, we have an evening reception with Wael Sawan, the CEO of Shell. September 30th, Jamison Greer is going to join us, the U.S. trade rep. October 6th, we have Niall Ferguson for an evening reception. And October 15, Arianna Huffington will be joining us for a virtual event. October 20, we're delighted that we'll be able to host Hakeem Jeffries, the House Democratic leader. And October 21st, Charlie Sharp, the president and CEO of Wells Fargo, will be joining us. On the 22nd of October, George Kurtz, the co-founder and CEO of CrowdStrike. And there are many, many more. So I should mention also late-breaking date change. Glenn Hubbard and Larry Summers will do a virtual event November 19th. So the programs were printed before that change, which got firmed up late last night. So for everyone in the room, thank you again for being here. For everyone online, thank you for joining us. And please be sure to keep tracking the website as we continue to make updates. As always, we do want to thank almost a third of the club is now a member of the Centennial Society. So we want to thank all of you that are attending today for your support, which helps to provide the financial backbone for the programming that we do today. And again, thank you, everyone. And everybody in the room, please enjoy your lunch. Thank you.